As we have seen previously, economic agents that provide capital are divided into two categories: institutional economic agent, such as bank, investment fund, and individual economic agent. It should be noted that investment fund is the global name for all the different investment and funds, such as exchange trade funds, ETF, hedge funds, and mutual funds. I quote those three examples because they are the most famous. But an investment fund can also take the form of a bond fund, a saving fund, and others. Through their different names, we will see what are their roles, particularity, and cost. We will also see that some institutions can have a much more important impact on economic or political life than you might imagine. The objective of these courses is that you will understand what their role is through divergent interest. Let's start. An exchange rate fund is a type of security that involves a collection of securities, such as stock, that often tracks an underlying index. Although they can invest in any number of industry sectors or use various strategies. ETF are in many ways similar to mutual funds. However, they are listed on exchange, and ETF shares trade during the day just like ordinary stock. A well-known example is the SPDR S&P 500 ETF, the SPDR, which tracks the S&P 500 index. ETF can contain many types of investment, including stock, commodities, bonds, or a mixture of investment type. An exchange rate fund is a marketable security, meaning it has an associated price that allows it to be easily bought and sold. The price of an ETF shares will change during the trading day as the shares are bought and sold on the market. This is unlike mutual funds, which are not traded on an exchange and trade only once per day after the market close. Additionally, ETF tend to be more cost-effective and more liquid when compared to mutual funds. However, the term ETF is a generic term that covers a wide variety of financial instruments. In fact, the ETF is a category of a larger family, the ETP, Exchange Trade Products. Within the ETP, we found the Exchange Trade Fund, the Exchange Trade Commodity and Currencies, and finally, the Exchange Trade Notes. ETFGI, a leading independent research and consultancy firm covering trends in the global ETP ecosystem, reported that ETF and ETP listed globally gathered net inflows of $68.95 billion in June, bringing year-to-date net inflows to $209.54 billion. Assets invested in the global ETP industry have increased by 6.1% from $5.31 trillion at the end of May to $5.64 trillion, setting a new record. Let's see the different forms of ETP. The exchange rate funds follow stock market indices in the equity market. They must comply with UCITS standards, which regulate the way they are produced and distributed to the general public. ETF represent about 90% of the ETP market in terms of assets managed. There are a large number of ETF that are distinguished by their composition. Here are a few examples. The best known of them is the SPY, which tracks the S&P 500 index, which is based on 500 major companies listed on the stock exchange in the USA. Thus, the SPY is composed of American companies such as Apple, Microsoft, Amazon, and others. This list represents 27% of SPY assets. Exchange-traded commodities and currencies are similar to ETF, but they track the performance of commodity or currency market, using a spot approach or using futures. These instruments are collateralized, which means that the exposure to counterparty risk is covered. The main difference between ETF and ETC is that the latter are debt instruments instead of funds. ETC expose investors to currency risk. They do not comply with UCITS standards, which means that they cannot be sold within the European Union. A well-known example is the SPDR Gold Trust. This year, the gold market boomed not only in terms of price, but also in terms of volume. For novice investors, gold ETF are the most practical instrument. But the purchase of a gold ETF is, in most cases, only an investment in paper gold. The holder of this paper has no guarantee on the physical gold. The total investment in ETF and gold-related funds currently reach $316 billion, or 4,878 tons, which is a record level. The 2020 growth in total value has been considerable and reached $160 billion, a 100% increase since the end of 2019. Then, exchange-traded notes are generally senior, unsecured, non-subordinate debt securities issued by banks and listed on a stock exchange. The issuing bank agrees to pay the performance of the index, fewer fees that depends on maturity. By purchasing this type of product, investors are directly exposed to the issuer's credit risk. There are two types of ETN, those that are collateralized and those that are not. The first is subject to partial or total coverage of counterparty risk, while the second is fully exposed to it. Investors must therefore have a very good understanding of the counterparty risk of ETN before investing. Hedge funds are known as speculative investment funds. A.W. Johnson Co. launched the first hedge funds in 1949. Hedge funds are alternative investment using pooled funds that employ different strategies to earn active returns, or alpha, for their investors. Hedge funds may be aggressively managed or make use of derivative and leverage in both domestic and international markets with the goal of generating high returns, either in an absolute sense or other a specific market benchmark. This is important to note that hedge funds are generally only accessible to accredited investors, as they require less SEC regulation than other funds, which is the Securities and Exchange Commission. When I say accredited investors, it means that hedge funds are only allowed to take money from individuals with annual income that exceed $200,000 for the past 2 years, or a net worth exceeding $1 million. Each hedge fund is constructed to take advantage of certain identifiable market opportunities. Hedge funds use different investment strategies and thus are often classified according to investment style. There is substantial diversity in risk, attributes, and investment among styles. Hedge funds can pursue a varying degree of strategies including macro, equity, relative value, distressed securities, and activism. A macro hedge fund invests in stock, bonds, and currencies, hoping to profit from changes in macroeconomic variables such as global interest rates and countries' economic policies. An equity hedge fund may be global or country-specific, investing in attractive stock while hedging against downturns in equity market by shorting overvalued stocks or stock indices. A relative value hedge fund takes advantage of price or spread inefficiencies. Other hedge fund strategies include aggressive growth, income, emerging markets, value, and short selling. Besides, this is important to know that hedge funds often use leverage or borrowed money to amplify their returns, which potentially expose them to a much wider range of investment risk. In the subprime meltdown, hedge funds were especially hard hit due to increased exposure to collateralized debt obligation and high level of leverage. Investment in hedge funds are illiquid, as they often require investors to keep their money in the fund for at least 1 year, a time known as the lock-up period. Withdrawal may also only happen at certain intervals such as quarterly or biannually. Besides, instead of charging an expense ratio only, hedge funds charge both an expense ratio and a performance fees. This fee structure is known as 2 and 20, thus 2% asset management fees and then a 20% cut of any gains generated. It is important to note that hedging is actually the practice of attempting to reduce risk. But the goal of most hedge funds is to maximize return on investment. The name is mostly historical, as the first hedge funds tried to hedge against the downside risk of a bearish market by shorting the market. Nowadays, hedge funds use thousands of different strategies, so it isn't accurate to say that hedge funds just hedge risk. In fact, because hedge funds managers make speculative investment, these funds can carry more risk than the overall market. Finally, I would like to take a well-known example. BlackRock managed $38 billion across a broad range of hedge fund strategies. This asset manager is listed within the top 10 of the largest hedge funds firms. The power of this type of investment funds is often unclear and not well known to the public.
L'argent gouverne le monde. Personne n'en possède davantage que l'investisseur financier BlackRock. La société dispose de plus de 6 000 milliards de dollars d'actifs. Ils proviennent majoritairement de gros investisseurs, mais aussi de millions de petits épargnants. Lorsqu'on brasse autant d'argent, on peut influencer des entreprises, des politiciens et même des États. Avec quelles conséquences pour nous tous? Pourquoi en sait-on aussi peu sur le plus grand des géants de la finance mondiale? Personne ne voulait me parler autrement que sous couvert d'anonymat.
I think BlackRock is an extremely dangerous company.
I invite you to watch this documentary in its integrity for the curious. It will be a very good practice for your financial culture. To conclude this video, let's talk about the mutual funds. Mutual funds pull money from the investing public and use that money to buy other securities, usually stocks and bonds. the value of the mutual fund company depends on the performance of the securities it decides to buy. So, when you buy a unit or share of a mutual fund, you are buying the performance of its portfolio, or more precisely, a part of the portfolio value. Investing in a share of a mutual fund is different from investing in shares of stock. Unlike stock, mutual fund shares do not give any voting right. A share of a mutual fund represents investment in many different stocks or other securities instead of just one holding. The average mutual funds hold over 100 different securities, which means mutual fund shareholders gain important diversification at a low price. Thus, mutual funds give small or individual investors access to professionally managed portfolios of equities, bonds, and other securities. Each shareholders therefore participate proportionally in the gain or losses of the fund. Mutual funds invest in a vast number of securities, and performance is usually tracked as the change in the total market cap of the fund, derived by the aggregating performance of the underlying investment. A mutual fund will classify expenses into either annual operating fees or shareholder fees. Annual operating fees are an annual percentage of the fund under management, usually ranging from 1 to 3%. Annual operating fees are collectively known as the expense ratio. A fund expense ratio is the summation of the advisory or management fees and its administrative cost. There is some advantages to invest in mutual funds. First of all, diversification or the mixing of investment and asset within a portfolio to reduce risk is one of the advantages of investing in mutual funds. Then, the easy access. Trading on the major stock exchange, mutual funds can be bought and sold with relative ease, making them highly liquid investment. Also, when it comes to certain type of assets, like foreign equities or exotic commodities, mutual funds are often the most feasible way. In fact, sometimes the only way for individual investors to participate. Then, the variety and freedom of choice. Investors have the freedom to research and select from managers with a variety of style and management goals. For instance, a fund manager may focus on value investing, growth investing, developed market, emerging markets, income or macroeconomic investing, among many other styles. And finally, the transparency. Mutual funds are subject to industry regulation that ensure accountability and fairness to investors. This video was important to give you the tools and information to understand those famous funds and investment. Most of you guys will only use ETFs. It may be a good strategy to begin to invest until you are able to create your own strategies and algorithms. That is the reason why in the next video we will explore the two main trading strategies, thus swing trading and scalp trading, in order to help you understand which trading style best fits you.